Welcome to Risk Finance Regulation 360, your space for clear, careful insights into risk, regulation, and modern finance. Imagine a future where every digital banking transaction is governed by a single, powerful set of rules. Today, we explore how new RBI regulations will reshape banking services, from mobile apps to UPI transactions. These changes mark a shift from self-regulation to mandatory oversight, ensuring improved security, transparency, and customer empowerment. As we trace the evolution of these measures, consider how this transformation might redefine your digital financial experience in today's dynamic landscape. The regulatory timeline reveals remarkable speed. In 2025, after a July consultation, the RBI finalized comprehensive guidelines, leaving banks little time to adjust. This swift consolidation of scattered rules marks a decisive shift away from self-regulation. Such rapid developments tighten the digital banking framework and usher in an era of structured financial oversight, emphasizing urgency and accountability in our evolving economic landscape. In an era defined by precision and accountability, the shift from self-declaration to obligatory RBI approval redefines how banks operate. Previously, digital services launched with minimal oversight, but now every new service must satisfy rigorous standards. This change raises the bar on cybersecurity, governance, and customer protection, ensuring that every digital initiative is both secure and reliable. It is a transformative move for the entire banking ecosystem. A new era of trust emerges. The new rules draw a clear distinction between transactional and view-only digital services. For transactions such as transfers and payments, prior RBI approval is mandatory. In contrast, view-only services that provide basic account information operate on a simpler infrastructure-based model. This focused approach enables banks to address security and efficiency requirements differently, paving the way for both robust functionality and streamlined user experiences. It establishes a balanced path for digital innovation globally recognized. Meeting the new authorization criteria requires banks to excel in 4 key areas. They must demonstrate financial resilience through strong capital ratios, prove technical aptitude with robust cybersecurity measures, enforce strict governance with board-approved policies, and deliver comprehensive reporting, including detailed analyses and grievance redressal plans. These rigorous standards seek to filter out weak operators and foster a secure, reliable digital banking infrastructure that inspires confidence in both customers and regulators beyond expectations. A significant breakthrough in these regulations is the emphasis on explicit customer consent. Banks are now required to obtain clear, documented approval from customers before any digital service is activated or deactivated. This mandates a transparent process where all service charges, rights, and responsibilities are communicated upfront. By prioritizing informed choice, the new framework protects consumers, ensuring that control remains firmly in their hands. This change redefines user autonomy while strengthening compliance globally. Shifting focus to customer freedom, the new rules eliminate forced bundling practices. Banks can no longer require mandatory app downloads as a condition for accessing other services. Instead, consumers enjoy the freedom to choose digital engagements on their own terms. This regulatory change dismantles coercive onboarding methods, reinforcing the principle that digital financial services must be entirely voluntary. It paves the way for greater transparency and trust in customer relationships for lasting improvement. The RBI's guidance delivers a significant message for financial inclusion, ensuring that digital banking remains a choice rather than a mandate. Traditional options such as branch and phone banking are preserved with full service, reinforcing user choice and security. This regulation guarantees that opting out of digital channels does not result in any restrictions or penalties, while accountability remains paramount. Ultimately, customers retain access to support and safety, regardless of their banking preferences. Mandatory transaction alerts enhance banking security by ensuring that every account operation triggers real-time warnings through SMS and email. This measure not only defends against unauthorized activity, but also allows banks to record mobile numbers for both alerts and KYC purposes without requiring full digital access. Notifications enable fraud identification, while tightened internal controls further strengthen the system. This approach effectively integrates safety with operational transparency and reinforces robust protections for every customer. Recent regulatory changes enforce tougher risk management across digital channels. Banks must impose per-transaction and daily limits to reduce losses from unauthorized access. Additionally, velocity checks monitor unusual transaction speeds to swiftly identify abnormal patterns. In cases of suspicious activity, advanced fraud detection, along with extra confirmation prompts, provide additional security. These measures are supported by mandatory technology upgrades that solidify the bank's defense and safeguard consumer confidence. Overall, this strategy strengthens trust. While risk mitigation has been strengthened, cybersecurity takes center stage. Banks are now required to undergo mandatory gap assessments by independent auditors to identify potential vulnerabilities before exploitation. Maintaining a record of cyber audits is essential for RBI authorization, ensuring secure digital operations. These stringent cybersecurity measures reduce fraud in online platforms and foster heightened trust in the digital banking ecosystem. This shift marks a significant advancement in protecting the entire financial landscape. Beyond strengthening cybersecurity, regulators now underscore robust governance and accountability. Banks must secure board approval for digital banking policies that align with overall risk appetite, elevating digital strategy to a core executive priority. Transparency in outsourcing and fintech partnerships is mandatory to ensure compliance, and banks remain the ultimate accountable entity for all digital services. This framework eliminates the possibility of shifting responsibility externally, reinforcing integrity and stability across financial operations. Trust endures. Recent regulatory changes introduce significant limitations on third-party product promotions. Banks are now prohibited from displaying unsolicited advertisements or marketing partner products once a customer logs in, ensuring that the focus remains solely on essential banking transactions and account management. This measure creates a streamlined, secure, and user-centric experience while preventing distractions. Additionally, regulators have incorporated specific oversight for high-value accounts to maintain rigorous standards and protect customer interests. It reinforces operational excellence. New rules establish targeted oversight for high-net-worth individuals by requiring banks to obtain prior RBI approval for transactional digital access for those exceeding a net worth of 50 crore rupees. This mandate introduces enhanced monitoring and stricter risk assessments, ensuring that high-value operations are accompanied by rigorous documentation and audit trails. Such measures add a critical control layer, promoting transparency and protecting high-risk profiles while reinforcing overall system integrity. It strengthens consumer confidence. Transparent terms and disclosures complete the consumer protection framework by mandating straightforward communication of service charges, fees, and potential costs. For maximum accessibility, information must be available in multiple languages, including English, Hindi, and regional dialects. The rules also detail a clear liability framework for unauthorized transactions, outlining user rights and bank responsibilities. This clarity ensures that financial interactions remain fair and secure, ultimately transforming the digital banking access process. It fosters trust. The new regulations ensure that mobile banking remains available and user-friendly across all telecom networks. This means whether users rely on Jio, Airtel, or Vodafone, their bank apps operate without bias. Furthermore, banks are now expected to provide varied options for account registration, making the process simpler, even in remote areas. This user-centric approach prioritizes access and empowers people through equitable digital financial services. It marks a significant shift in modern banking innovation. The streamlined UPI linkage process redefines how digital payments work, allowing users to connect directly with third-party apps without unnecessary hurdles. Now, when linking a bank account, you have the freedom to choose apps like PhonePe or GPay, without being forced into a particular bank application. This freedom reinforces user autonomy, simplifies payment procedures, and builds trust in the digital payment ecosystem by ensuring that every step respects your consent and convenience undoubtedly. The updated regulations will ripple through the financial ecosystem. Banks face immediate challenges, including increased setup costs and comprehensive revamps of their onboarding procedures, while IT service firms find new opportunities to enhance digital systems. For consumers, this leads to safer, more transparent financial interactions, where control over personal data is paramount. Ultimately, these changes promise a more balanced environment that rewards innovation and robust risk management, driving progress and increased market confidence. A notable shift has occurred as banks move away from forced app bundling to embrace voluntary consent. Previously, coercive practices often led to user frustration and regulatory complaints. Today, the framework prioritizes user empowerment, fostering trust and engagement. By valuing consent and removing coercion, the financial system creates an environment where customers are free to make informed choices, strengthening accountability and paving the way for more transparent digital interactions, echoing a new era. This new framework establishes clear responsibilities within fintech partnerships. While the RBI governs policies and oversight, banks retain primary responsibility for customer protection and compliance. Fintech partners deliver innovative digital service solutions, yet they must operate within strict regulatory guidelines. Such accountability prevents banks from outsourcing risk management. In essence, this structure secures the financial landscape by ensuring that every participant remains answerable for preserving security and maintaining trusted standards, ensuring lasting trust. Anticipating April 2026, banks will adopt a risk-based approach to authentication. Instead of relying solely on static OTPs, they will leverage behavioral analytics and device fingerprinting to validate identities. In practice, this means higher security for significant transactions, while routine payments require minimal verification. By dynamically adapting security protocols according to risk, the system reduces fraud and improves user experience, reflecting a thoughtful balance between ease of use and robust protection in practice. The upcoming changes to BSBD accounts mark a transformative step towards financial inclusion. From full digital banking access to complimentary debit cards and account statements, these measures remove traditional service barriers. Additionally, eliminating fees for cash deposits both in branches and ATMs levels the playing field. As banks face tighter controls on liquidity, consumers stand to reap the benefits of improved, accessible, and cost-effective banking services, ushering in a new era of banking. Digital banking is evolving, yet it brings its own risks. The RBI's updated liquidity rules require banks to classify deposits sourced digitally with extra care. Because digital deposits can fluctuate quickly, especially during crises, banks must apply higher runoff factors during mandatory stress tests. Adjustments to funding models and increased risk buffers are now essential. In ensuring systemic stability and managing fraud effectively, these regulatory shifts mark a necessary evolution in banking operations. The new regulatory framework signals a transformative shift in fraud prevention for digital transactions. Banks are transitioning from outdated rules-based systems to monitoring powered by AI analytics. Machine learning now sifts through extensive data to catch subtle signs of fraud that might otherwise go unnoticed. This proactive approach reduces financial risk and builds trust in digital services. Pattern recognition is pivotal in safeguarding customer assets and fortifying the security of digital banking operations. After exploring the regulatory overhaul, 5 main changes stand out for 2026. The RBI demands explicit documented consent, replacing previous implicit practices. Forced app downloads and bundled services are eliminated to ensure service autonomy. Transaction alerts via SMS or email become mandatory to enhance fraud prevention, while external cybersecurity audits replace self-assessments. Additionally, banks must obtain RBI approval before launching services. These measures collectively promote responsible innovation in digital banking effectively and sustainably. Focusing on the philosophy, these regulatory changes drive responsible innovation. They directly address real-world challenges such as forced apps and inadequate customer protection. The RBI establishes clear standards for authorization, consent, and cybersecurity across digital channels. This framework compels banks to modernize their systems and policies, ensuring they align with the evolving regulatory landscape. Ultimately, this regulatory shift fosters innovation while safeguarding user safety and creating a secure, transparent digital banking ecosystem globally. Mandated authorization and tighter compliance standards open significant opportunities for IT firms. The new RBI mandates for explicit consent, robust risk mitigation, and comprehensive cybersecurity audits create demand for specialized technology. This presents a market for developing advanced consent engines, risk analytics, audit platforms, and secure onboarding modules. IT firms that integrate these solutions into existing core banking systems are essential for achieving full compliance. This shift significantly drives tech investment in finance. Looking ahead, the future of digital banking in India appears set for profound transformation. With the shift from fragmented regulation to the 2026 mandates, trust and adoption are expected to surge. Stricter controls and mandatory audits are projected to reduce fraud by 2027, while enhanced security and transparency pave the way for deeper integration by 2028. These measures aim to restore confidence across all segments, particularly benefiting previously underserved communities with real impact. In summary, 4 core takeaways define the regulatory transformation. Explicit, documented consent replaces outdated practices. Forced digital interactions are no longer permitted, ensuring genuine user choice. Stringent security measures, including mandatory alerts, tighter risk controls, and independent cybersecurity audits, significantly enhance system protection. Ultimately, these changes empower users by making digital banking a secure, transparent, and choice-driven experience. Each element reinforces a commitment to robust governance and improved financial integrity for lasting progress. Thank you for joining this deep dive into the RBI's new digital banking rules for 2026. The regulatory changes form the foundation of a transformed banking landscape, delivering a more secure, choice-driven experience for customers. Reflect on which change resonates with you most as we explore this evolution. Your insights enrich the dialogue on a future built on stability, innovation, and thoughtful regulation. Your perspective makes all the difference in shaping our future.
Thanks for watching. For consulting and advisory engagements, you can reach us at regalwiseconsulting@gmail.com. Please share your thoughts in the comments and suggest the topics you'd like us to cover next.